Thank you very much for the opportunity to be presenting here today. So the title of my presentation is Debt-Led Growth and its Financial Fragility, an investigation into the dynamics of the super multiplier model. And the point of the paper is to, I'm trying to pass on my slides, there we go. So the point of the paper is to explore the possibility of developing a demand-led growth model where household debt finance consumption is the driver of growth, but actually trying to explore the financial sustainability of such models. So the idea then is to suggest a type of super multiplier model where household credit finance consumption is the driver of growth, and ask ourselves if this is a financially sustainable model of growth from the perspective of these households that have to get into that. And the way that I organize the paper and I've organized this presentation is, first, I'm going to do a very brief review of demand-led growth theories that try to incorporate debt finance consumption, really just to show where the suggestion of the model that I'll make here actually fits in. Then I'm going to actually suggest a demand-led growth model where we're going to have household debt finance consumption being this autonomous component of demand that drives growth. But really, the main point of the presentation today and of the article is to actually explore and discuss if this model of growth that we are developing is financially sustainable. So from the perspective of the household, is it something that households can actually sustain in the long run as a steady state solution? So in terms of the review then of growth theories, well, we all are very familiar with this, right? The Neo-Kaleckian growth theory assumes that investment is the autonomous component of demand that drive growth. And then so growth is determined by capital accumulation, so that consumption needs to always be determined by current income. There has been a few attempts to incorporate household debt finance consumption into these type of models, but what we'll see is that consumption always will have to be somehow determined by current income. Here, I'm going to be emphasizing two models that is of interest to me, Dut's model and then the Satterfield and Key model, really because we'll see that I use as a basis for the development of the model that I'll do further on. So what we have then in Dut's model, here, well, workers' consumption is then partially determined by current income, directly by the current income, so they consume out of their income, but there's also a part of consumption that is debt finance. But this debt finance component of workers' consumption is explained by a debt target, and then this debt target is endogenized to workers' current income, making then households' consumption becoming fully determined by their current income. Now, Satterfield and Key model, we have something similar. So we have the workers' consumption being partially explained by workers' current income, and then a part of it is debt finance. But in the case of the Satterfield and Key model, what we have is that this debt finance component is explained by a consumption target, and then this consumption target is explained by a type of emulation effect. So it's this idea that households will use credit to consume because they are trying to keep up with rentiers' household consumption. And so they are trying to emulate their consumption. And so you endogenize this consumption target to rentiers' current income, so that in the end, once again, we have households, workers' consumption being fully determined by current income. But the Satterfield and Key model, however, does allow us to have a discussion on the stability analysis. So when we're talking about then this debt finance component being determined by the consumption target, that allow us for a stability analysis of the debt to income ratio of workers, which is what is of interest to us. Also, there has been a few critiques to these type of models, one of which is that all of the previous approach need always to have the rate of capital accumulation determining the growth of that, right? Because, well, investment is the autonomous component of demand that drives growth. And also, we are all very familiar with the critique on the capacity utilization and the Herodian instability, which I'm not going to get into it. So moving on then into the super multiplier framework, right? We have that investment is not the autonomous component of demand. What we'll have is then the possibility to consider other components of demand as the autonomous components of demand that drives growth, one of which then could be workers' credit finance consumption. This has already been done, for example, by Pariboni, but also 2016, but also Fagundes' PhD dissertation, where they suggest the possibility that household expenditure financed by credit can be then this autonomous component of demand that is driving growth. The other perspective that we also wanted to incorporate is this idea of a semi-autonomous consumption. So is this idea that, for example, is developed in Brochet and Siva paper, where they think about a super multiplier type of model where households consumption is determined, is explained or is partially financed by accumulated wealth, so that then this household's consumption becomes semi-autonomous from a household's current income. So then what we want to suggest here is a model as we are explaining here. So what we have then is consumption is divided into workers' consumption, rentier's consumption, and then rentier's consumption is fully explained by their income, so they only consume out of income, but workers' consumption is allowed to go beyond their current income, because they are allowed to either save or dissave, so get into that in order to consume. So it's this idea then that workers' consumption is going to be explained partially by their income, but also by a savings or debt decision, right? Depending on if this is positive or negative. So if it's a positive savings, then its workers will be taking out income from their consumption. But if this is negative, so if they are dissaving, then actually this will be adding into their consumption, and then they will be getting into that in order to consume beyond their income. And so what we assume here is that this savings or debt decision then is determined by a wealth or a debt target. And so is this idea then that we are allowed to think about a workers' consumption that is determined by a wealth or debt target. But in our case, we don't have to endogenize it to current income because we are following a super multiplier approach, right? That's approach, we had to endogenize it to current income. Here, we don't have to, we can just leave it as an autonomous component of demand. So as an exogenous factor explaining household consumption, household credit finance consumption. Right. So if we're going to look at the steady state analysis, what we'll have then is that in our model, the autonomous component of demand, the Z, which is always very important for the super multiplier approach, is going to be explained by workers' credit consumption or credit finance consumption. And then what we'll have is that growth in this model is going to be explained by the rate of growth of the autonomous component, which is then in our case, the rate of growth of the stock of debt. Right. And this is actually a result that is not different. There's not very different from Pariboni or from Fagundes, but actually the point of this paper is really to look at what is going to be happening then to this ratio. So, right, if we are assuming this type of model and then we have that in steady state, this is the rate of growth of the economy. So what is happening to this ratio here, which is the ratio, it's going to be, right, the ratio of debt to capital stock. So the stock of debt to the stock, the ratio of stock of debt to the stock of capital, then really following an analysis that is similar to what was done in Setterfield and Kim model, but now looking at how can we do this analysis for a type of super multiplier model. Right, so Setterfield and Kim then they develop a model, as I said, a Neo-Kalecki model, and they look at the dynamics of the ratio of the stock of debt to the stock of capital, and we want to see then what is going to be the behavior of this ratio D in steady state, right? So we want to look at what is going to be the behavior of this ratio, and we want to compare this to a maximum ratio, a maximum level of ratio, which is going to be defined by the maximum amount of that households can service. So it's this idea that, well, if households are not even consuming, they are just using all of their wages to service their debt. So that would be then the maximum amount of debt that households can actually accumulate. And so we want to compare this definition of D max to the dynamics of this D ratio then in steady state. So, and this is what we get. So then, first of all, this graph here, what we have is then D dot, which is then the dynamics of the ratio against the actual ratio. And this is, so what we are assuming is an income distribution of 40%, so a profit share of 40%. And then these are the parameters that we are assuming. So if the economy then is growing at 3%, this is what we observe then in terms of dynamics. So what we see here is, first of all, it's a dynamics that converges to the fully steady state position, right, where this ratio stops changing. So we have d dot equals 0, and then we would arrive at a fully adjusted position when where d dot is equals to 0, and then this d, the ratio of debt to capital stock, then would be a negative ratio, then arguing or showing that we would require households to be accumulating debt as opposed to wealth in this fully steady state position. Now, if we actually assume a positive rate of growth, a negative rate of growth of -1%. So if the economy is, so we actually have a negative rate of growth of the economy equals, or a rate of growth of GDP equals to -1, what we observe is a positive dynamics between D dot and D. So this shows, first of all, that it's an unstable dynamic. So unless we are already at the fully steady state position, we're not going to converge to it. But if we are at the steady state position of the fully adjusted position, then what we have is a positive ratio, which then shows that households will be accumulating wealth as opposed to be accumulating debt in a scenario where the economy is degrowing as opposed to growing. So, and this is what it looks like for the different rates of growth. So here what we have is the dynamics of D, so D dot, then this is the ratio, the actual ratio, and then this is for the different rates of growth. So we can see if we have a negative rate of growth, we have then this positive dynamics showing that it's unstable for negative rates of growth of the economy, and the fully steady state adjusted position is positive, showing then that households are accumulating wealth. Now, if we have a positive rate of growth, we can see that the dynamic changes. We have then this negatively sloped relationship between D dot and D, showing then that it's stable, so it converges to the fully steady state adjusted position, but that fully steady state adjusted position requires households to be accumulating debt as opposed to wealth. And so this is what it looks like. So because we want to compare actually that dynamics with a maximum level of that. So this is what it looks like. So this is basically the levels of fully adjusted position. So the levels of DT for the points where D dot is equal to 0. So so those are the fully adjusted positions levels of the ratio for the different rates of growth. So here we have JZ, the rate of growth of the economy, and then here is the DT for the D dot equals 0, so the fully adjusted position. And what we observe then is that for positive rates of growth of the economy that are not too high, we observe that this ratio, the fully steady state position, will require households to accumulate a level of that goes beyond their Dmax, which would be then this maximum amount of debt that they can actually service. So what we observe then is that if we are going to have actually very feasible rates of growth in this economy, we will require households to be accumulating a level of that is not financially sustainable from their perspective. And then the sort of final question that we ask, well, because in order for us to do this analysis, we need to assume a set of variables, right, for pi, the profit share, for CPI, the consumption of rentiers, for the interest rate, for the normal rate of capacity utilization, or for the capital and output ratio. And what we want to ask ourselves is, well, is this real, is this dynamics that we are observing just because of the values of the parameters that we are assuming? And what we'll see is that it actually doesn't change much. So we're going to be showing a little bit what happens if I change a little bit the parameters around. And what we'll see is that, well, the interest rate has a few effects that are interesting to observe, but the other parameters don't really change the dynamics. What we'll observe is basically the same results that I have just shown. So in terms of the interest rate, I guess I put this one first because it is the one that we observe most changes. So if the interest rate, the first analysis that we did, we assumed an interest rate that was equals to 2%, but if it's smaller, 1%, then here is exactly for all the same parameters. But if the interest rate is equals to 5%, and here is if the interest rate is equals to 10%. And what we observe then is that the dynamics is not that different. We observe more or less the same type of dynamics, where we have that for positive rates of growth, so rates of growth that are positive, but not too high, there's some point at which then the economy will require households to accumulate, the workers' household to accumulate a level of that is not financially sustainable, right? So this is always, the gray line is always the Dmax. And then what we observe here is that for a fully steady state position here, for for example, 10% if the economy then is growing at a rate of growth that is between 0.02 and let's say 0.01, so 1 and 2%, which is a very feasible rate of growth, then we require households to be accumulating a level of that is really not sustainable from their perspective. And so this is the idea, and actually really the difference that we are observing across the different types of interest rates that we can assume here is, well, first of all, the Dmax changes, and it changes, of course, because, you know, the higher the interest rate, the less amount of debt they will be able to service. So of course, the ratio needs to adjust, and it also moves a little bit more, but the point still remains the same, that for actually rates of growth of the economy that are positive, but not too high, actually very feasible rates of growth of the economy, we would require households to accumulate a level of debt that is not financially sustainable for them if we're going to follow this type of debt-led growth approach in the economy. Right. And then in terms of the changes in income distribution, I mean, mostly it's really the ratio, the Dmax, right, that is going to change. But the dynamics that we observe across the different possibilities of income distribution, so the different possibilities of the value for the profit share, doesn't change much, the dynamics. And we can say the same thing for the capital output ratio. We also change it, and we can see that the Dmax is changing, but the rest of it doesn't change much, and the result still remains the same, that for rates of growth of the economy positive but not too high, we eventually run into a problem of, you know, requiring a level of that is not financially sustainable from the perspective of the household. The same thing for the rate of capacity utilization that we change, though usually in the literature we tend to see the normal rate of capacity utilization being referred to as more or less equals to 80%, and then for rentiers consumption, marginal consumption, also we don't really observe a significant difference from assuming the different values. So in terms then of the results that we have found, well, first of all, you know, what was already expected in this type of super multiplier model, we have that the rate of growth of the economy is going to be determined by the rate of growth of the autonomous component of demand, which in our case is, well, basically going to be the rate of growth of the stock of that, if we have a positive rate of growth of the economy, or if we have a negative one, then it's going to be the accumulated wealth of households. We also find that for positive rates of economic growth, the model usually requires that households accumulate debt and not wealth, otherwise we're going to have a negative rate of growth. And then finally, also we observe that for positive rates of growth of the economy that are not too high, the model actually does converge to a ratio, right, of the stock of debt to the stock of capital that is not financially sustainable from the perspective of households. So that means that basically they will require households to accumulate a stock of that they would not even be able to service their debt. And here it's important also to notice that we've been very generous to our definition of a maximum level of debt. I mean, we followed Satterfield and Kim, but this is actually a very generous definition of what households can actually keep up with, because what we're basically saying is we are defining this the max to be at a point where households are not even consuming, they are using all of their income just to service their debt, right? So it's really a sort of very generous definition that we should actually think, I mean, when they reach that point, it's already not financially sustainable for them. But yeah, so those were the final remarks. Thank you very much.